Hello everyone, welcome to our Accounting 312. In this video, I want to talk about the final review. This is just my review. I'm still working on your final exam, so once I get the first draft done, I will share more details information with you. So let's get started. I go with the order that we learned all the chapters. Chapter 9 talking about variable costs, and then chapter 9 talking about absorption costing and variable costing, right? So I should say variable costing. And then I don't know why I thought it's variable costing, but it's a variable costing and absorption costing. Make sure you know the definition, what's the meaning of variable costing. I put the formula also here. So variable costing, I believe now you feel much better after you learn the chapter 3 CVP analysis. We classify all the costs based on variable costs or fixed costs, right? But for the absorption costing, we classify based on its manufacturing or its non-manufacturing. Make sure you know the definition, and then the main difference is how do we classify our fixed manufacturing cost. Under absorption costing method, fixed manufacturing cost will be part of your inventory. But for variable costing, fixed manufacturing cost will be the period cost and will be expensed immediately. So why is it important? Because if it's inventory cost, if it's your product cost, you cannot expense it until you sell it. So you only get cost of goods sold when you sell your units. When your production is the same as your sales, those two methods, they will give you the same operating income. But if you produced more units than the units sold, let's say you produced 10 units, you only sold 8 units. So you can only expense 8 units. You can only expense the 8 units, the fixed manufacturing cost. So you still have 2 units, the fixed manufacturing cost, they are not expensed. They stayed in your balance sheet as the ending inventory. That means under absorption costing method, you expensed only 80% of the fixed manufacturing cost. So you didn't expense all of them. Your total cost will be smaller. Your operating income will be larger, will be bigger. Make sure you know how do you get the operating income for both methods. One more time, as I mentioned, you already learned chapter 3 CVP analysis. I don't worry too much about the variable costing method. For the absorption costing method, in order to get the operating income, you have to do 2 steps. The first one is you have to calculate the inventoryable cost for each unit, which is your variable cost, the variable manufacturing cost, I would say, plus the fixed manufacturing cost for each unit under absorption costing method. Under variable costing method, you only do variable manufacturing cost. And then once you get the inventoryable cost per unit, you time the units sold, that gives you cost of goods sold, and then you subtract all the non-manufacturing cost. Effect on operating income, as I mentioned, if your production is more than the sales, your operating income under absorption costing will be higher. And then you have to know how do we adjust, right? How do we adjust, reconcile from this method to that method? The difference, remember you produced 10 units, you sold 8 units, so you still have 2 units. The difference will be the 2 units as the ending inventory time your each unit allocated fixed manufacturing cost. If you say, hey, you allocated like $6 per unit, then will be 2 units times $6 gives you $12. Okay, I just made up the number. Your question will be different from the numbers. That's I already said. You said fixed cost of goods sold. You have to sell it. So it's variable manufacturing cost plus your each unit the fixed manufacturing cost time the unit is sold. if I just tell you, hey, fixed manufacturing cost, variable manufacturing cost, that's easy, right? But I remember we practice some question instead of telling you what is a fixed manufacturing cost, what is a variable manufacturing cost. You have to know, right? Direct material, direct labor, those are variable manufacturing cost. Fixed manufacturing cost, like straight line depreciation expense, right? Like the insurance for the manufacturing department. So it has to be manufacturing cost and then has to be fixed. Okay, that's the thing I want to point out. You have to kind of know, hey, what's the meaning of manufacturing cost? What's the meaning of fixed cost? The last thing, as we mentioned, we said if you produce more units than the sales, under absorption costing method, you will have a higher operating income. So this is kind of a way of earnings management, or you manage your earnings, manipulating your earnings. You can only do this under absorption costing method. And then, absorption costing is for external, if you are the listed company, you do the follow the gap. This is the way you follow. So some managers, they just have the motivation. They also have the tool to manipulate their earnings by producing more units than the units they sell. So if I say, hey, variable costing method will give managers opportunity to manipulate earnings, that's the wrong statement, right? That's the wrong statement, because you only do that under the absorption costing method. Okay, I think that's all about chapter 9. If I say, hey, what's really hard to meet, I would personally think the calculation of operating income under absorption costing method. And then, as I say, you have to know, I tell you something, direct material, it's variable manufacturing cost. If I tell you his CEO's salary, you have to know that's just the period cost, that's non-manufacturing cost. So that's the thing. You may want to go back to chapter 1 to get the concept there. Next chapter, after we finished chapter 9, we started the chapter 3, CVP analysis. We practice a lot of questions, CPA, CMA, those questions. I think the material, is kind of a lot, but the logic is very clear. Most students, they like this chapter. I know you are very smart, you like doing numbers. So this chapter, I don't think there are a lot of hard things. So let's review this together. First thing is the CVP assumption. Most likely, I don't ask students to memorize things, but as I mentioned, why I put this, because CPA tested you here, so make sure you go to your textbook and read a little bit of the assumption. So after the assumption, the main thing is calculation. Chapter 3, just if you tell me, hey, what's the main word, I will say contribution margin, right? Contribution margin. Know how do you do this for the dollar amount, and then how do you get the contribution margin percentage. Make sure you know calculation. I think calculation, it. For contribution margin, is selling price minus variable cost for each one, or it's total revenue minus your total variable cost gives you total contribution margin. But what's the meaning? So let's say, hey, contribution margin for this pen, I'll just make a number. Let's say a contribution selling price is $10, variable cost is $3. The contribution margin for each one is $7. So that means when you sell one more unit of this pen, you have $7 that can be contributed to cover your fixed cost and then to increase your operating income, right? That's why we call it a contribution margin. We don't call it a 销售送 margin, right? You don't call other margin, it's a contribution margin. It can be used to contribute to cover your fixed cost and then increase your operating income. Contribution margin percentage is your contribution margin divided by your selling price. So in that case, selling price is $10, variable cost is $3, contribution margin is $7 for each unit. I use per unit. Then contribution margin percentage will be 70%. So that means, whenever your sale increased by $20, your contribution margin will increase by 70% of $20, which is $14. One thing I want to point out is if you use contribution margin per unit, then you have to use the selling price per unit, variable cost per unit, fixed cost per unit. If you use total, then you have to use total revenue, total fixed cost, total variable cost. So you cannot use per unit mix up with the total dollar, right? After that, we also talk about break-even point. Basically, it's how many units you have to sell to cover your fixed cost. So your fixed cost divided by contribution margin for each dollar amount, that gives you the units. But if you fixed cost divided by contribution margin percentage, that gives you the dollar amount. We also talk about if you have a targeted operating income, then your numerator will just not just fixed cost, but also target operating income. We also did is if you have the after-tax income, right? After chapter 21, you should feel very comfortable with the tax. So if it tells you after tax, you want to get $70 and tax rate is 30%, then before tax, your operating income has to be $100. So those things, just the numbers, I don't worry, you are very smart. I don't worry about you. We also talk about decision making. We talk about 3 situations at least. Change selling price. What I said, selling price, right? Change selling price. And then if we put more fixed cost to do advertisement, or if we decrease our variable cost, those things, what will happen to our operating income? One thing I think is important is if you change the volume, you used to sell 100 units, now you sell 110 units. When the sales volume changes, your total revenue will change, but your total variable cost will also change, okay? So the common mistake is some students, they know, hey, you sell more, your revenue will be more, but they still use the original variable cost. That's wrong, because your total variable cost will also change when your sales volume changes. That's the thing. Other than that, you do a lot of CPA question, you practice a lot. I think you should be fine. Next part, we talk about margin with safety. 2 things you first want to know: what's the meaning of margin with safety, right? It's just the margin that you are safe. In business, when we talk about safe, that means you are at break-even point. You are not losing money, you are not earning money. It's kind of like you getting safe in the class, right? 70%, 70%. You don't want to get 69. So 69, you are not safe. 70, you are good. So the difference will be the margin, right? Currently, your total points is 98. You just need 70. So you can drop by 28 points before you say, oh, I will fail the class. You don't want to fail the class, right? So managers, they don't want to have a negative income. I put this situation is just your current sale is $600 and the break-even point is $400. Your margin is $200. You want the margin to be large. Larger margin means you are safer. So let's say put a multiple choice, which statement is correct. Smaller margin means you are safer. That's wrong. Okay, that's kind of how do you apply it to the multiple choice. It's the main thing is still calculate the break-even point. The main thing is still, that's how I put it here. Main thing is still calculate the break-even point. Part 6, sales mix. I think very likely I cannot say definitely, but 90% you will have a question from there. I'm not going to talk too much. Just go back to your textbook. Instead of I should say 6 sale mix break-even point, right? So instead of getting, hey, you sell this pen, you also sell a phone. You sell 3 phones, you will get 20 pens. Kind of like that. So the concept is you put them as a bundle. So you first get the bundle break-even point, right? How do you get bundle break-even point? You get the bundle contribution margin first, and then you use total fixed cost divided by bundle contribution margin. You get how many bundles you need to sell. Then once you get bundles, then you time the units of phone in the bundle, time the units of pen in the bundle you will get for each product. I think make sure you know this one. We practice a lot, so make sure you get this one. Last thing is contribution margin and the gross margin. If you already did chapter 9, you should kind of know that if I say, hey, just let's just say, if you increase your, how can you have a variable fixed cost? I want to say fixed manufacturing cost, right? And then fixed non-manufacturing cost. You know what I'm talking about? Fixed manufacturing. Okay, so let's say if you increase the, so I make a number. Let's say, what should I do? Okay, I found one. Okay, so if you increase your variable non-manufacturing cost, like sales commission, instead of $2 per unit, now you increase to $3. How will that affect your contribution margin and the gross margin? If you increase your variable non-manufacturing cost, your contribution margin will decrease, but it will not affect your gross margin, right? So those are things, once you know these two formula, you should be fine. One more time, you have to know what is variable manufacturing cost. You have to know what is variable non-manufacturing cost. So those things in chapter 1 and chapter 2. Okay, chapter 3, very, very important chapter, but as I keep saying, logic is straightforward. I don't worry too much, just to be very careful when you do the calculation. Chapter 11 is also important chapter, especially now we use that concept also in chapter 21 when we talk about relevant cash flows. So you have to know what's the meaning of relevant. You have to meet both of these, right? Happens in the future and makes difference. So if I ask you, hey, which statement is correct? All the information that makes difference will be relevant information. You know that's not correct because it has to happen in the future. We talk about wrong assumption. You cannot say all of the variable costs are relevant, all of the fixed costs are irrelevant. You cannot say that. You have to read the question. But if the question doesn't tell us anything, you can assume for that question, hey, variable cost is relevant, fixed cost is not relevant. We also talk about different situations, but I kind of break it down and organize with whether you have opportunity cost or you don't have opportunity cost. You want to know, you definitely need to know what's the meaning of opportunity cost, right? You give up something to get something. Yeah, I'll give up this pen to get this phone. So the opportunity cost of getting this phone is I cannot get this pen. How do we define whether there is opportunity cost, yes or no? If the question tells us you have idle capacity, you have excess capacity, then that means you don't need to give up anything. You can do whatever you want to do. You know, you don't need to give up something. Then you don't have a limited resource, then there is no opportunity cost. For that situation, you just need to think about relevant variable cost and the relevant fixed cost. What's the meaning of a relevant fixed cost? Is the avoidable part. Is the avoidable part. So some students, you know, if you go to your handout, you should know what I'm talking about. If you make or buy, let's just say, if you buy, you can avoid 40% of the fixed cost. Then that 40% will be relevant. The other 60%, no matter you make or buy, you cannot avoid it. So there is no difference. So that's irrelevant fixed cost. Okay. We talk about one-time special order. You say, hey, should you get this special order? Your regular selling price is $10. Variable cost is $3. Somebody just offered to buy it one time and give you $4. Should we accept it? Yes or no? Concept is as long as relevant revenue $4 is more than relevant cost $3 in this situation, you should take it because there is no opportunity cost, right? This is a short term. I put chapter 13. It's a long term pricing. In long term, everything is relevant. So we have to put the full cost plus the profit. Also make or buy situation. The rule is if purchase price is more than the relevant cost of making, then we should just make it. If you make a pencil, relevant cost is $3, but if you buy, purchase cost is $4, you know, why buy, right? We just make it and we save $1 for each unit. So that's no opportunity cost, but if you have opportunity cost, you are already working at the full capacity, you want to do something, you are already working 24 hours to make this pencil pen. If you want to make this cell phone, then you have to give up of this pen, right? So you have opportunity cost if you are already working at the full capacity, and then you also have alternative use, then you will have opportunity cost. In that situation, you should think about relevant variable cost, still think about relevant fixed cost, but also think about, also you have to include the opportunity cost. You have to include the opportunity cost. I'm not going to say too much. We talk about, I think in the handout, we did a lot of calculation. And then one multiple choice said, hey, if you make this, remember, so kind of you make this product, right? If there is no opportunity cost, you have an excess capacity, you just need to think about the variable cost, like $3. But if you are already working at the full capacity, you still want to make this pen, you have to give up the phone. So the opportunity cost of the phone is $2. Let's just make a number. Minimum price has to be $5. Remember that question? Go back to those handouts. I think make sure you really know where to put the opportunity cost. If it's make or buy, opportunity cost is the cost, right? So it's extra cost of make, because if you make the pen, you cannot make the phone, right? I hope you know what I'm talking about. I don't want to go to too detail and explain questions. If you say, hey, I don't know what you're talking about, it's better to go back to your textbook and handouts. Next situation is a product make a decision. So we say, especially you have a constrained resource, you just have 24 hours, you just have 10 machine hours. So you should focus on the one that gives you the highest contribution margin with the constrained resource. Go back to your textbook. I think we just practice 2 or 3 multiple choice. Last two things is, one is add or drop the customer. Keyword right there is depreciation expense. If you add, depreciation expense will be relevant because you have to buy equipment for this special customer. So in that situation, depreciation expense will be relevant. But if you drop a customer, you already bought the equipment. So no matter you drop customer, yes or no, there is no difference. The depreciation expense will be not relevant. So that's the thing you want to know. Last thing is keep or replace the equipment. In chapter 11, it's easy. Just to know what's relevant. The cost there, I think, is cost of a new machine, selling price of the older machine, right? And then all the operating income or the cost for the old or new machine. After learning chapter 21, you go back to chapter 11. This part you will say, oh my goodness, it's just so easy. We don't need to deal with the gain or loss or tax. But in chapter 21, we have to think about those things because of tax payment and tax saving from gain or loss from depreciation expense. Okay, so those 3 chapters we learned before our first test, for our first exam. I think that kind of 2-3 months ago. Make sure you go back to those 3 chapters. Let me know if you have any question. Chapter 14, 13, 12, I would say kind of straightforward, kind of light, right? And we follow textbook more. I give you more practice also. And then you did your exam 2, I would say, I don't know whether you still can review your exam 2, yes or no, but go there to review exam 2 and get some idea for those 3 chapters. I'm not going to really read those things because, as I say, just focus on textbook, kind of that 5-level category, unit level, batch level, customer level, channel level, and then division level. So those are 5 level. And then other factor, we cannot just think about the profitability. We have to think about other factors. Also talk about cost allocation decision. We say if we don't allocate, then we have to do the, the hierarchy income statement, right? So we just subtract the channel level, subtract the division level directly. But if we want to allocate it, we don't do the detail, but if we want to allocate, there are 4 criteria to follow. I'm not going to repeat, just to make sure you read textbook. That's the thing we have been practicing a lot, variance, calculation, interpretation, relationship. If I tell you market size variance is $2 favorable, market share is $3 unfavorable, then your sales quantity will be $1 unfavorable. So those things you have to know. This part, one more thing, Robbie said, if you use my formula, the first variable is the total unit. And no matter you do one product or you do the company, you have to use total units and then time the percentage and then time the contribution margin. So the first variable is total units. One more time, it's total units. It's not just the data product unit. I hope you know what I'm talking about, because very likely I may test you one more time. I make sure you really know that part. Composite unit, that's the new thing. Make sure you know that. Market share, market size, that's the new thing. You want to know that. The other static budget variance, and then flexible budget. Those you already learned in chapter 311, right? 311. I will test you. If I test you, I'll definitely test you the new things. Sales mix variance, only one product, composite unit, market share, market size, those things. Chapter 13, talking about pricing. This is for long term. I'll just go back to chapter 11, talk about short term. 3 factors for demand and supply, cost, computation, and customer. For purpose of the allocation, I'm not going to repeat it, just know for purpose, go back to a textbook, because I cannot remember, cannot remember either. Two approach to set the price. If it's competitive market, we do the market based because we cannot decide the price. The market already decided for us. All we can do is we do the value engineering to get the target cost, right? Your revenue market told you for this pen is $10, and you have to earn $2 for each one. So your target cost will be $8. And then when we do value engineering, make sure you separate the value added, non-value added, cost incurrence, and lock-in cost. I don't want to read those concepts. I hope you still know what I'm talking about. And then the other approach is cost plus approach. So if it's not so competitive market, you can use this one to cover your cost and also charge reasonable plus, right? We call it a plus, we call it a markup, we call it required return, kind of those things. So make sure, how do we get our selling price, especially markup percentage, right? Markup percentage is your markup divided by cost. It's not divided by selling price, it's divided by cost. And then we also talk about if the cost base is small, you have to mark up a larger percentage. If the cost base is large, you just need to mark up a little bit. Hope you still remember that one. Goodness. Almost done, last page. Chapter 12, talk about the strategy, balance scorecard. I don't think there is important like calculation there. Mainly it's just the concept. So for the strategy, there are 5 elements for the industry analysis. I don't want to read, but basically it's the current competition, equivalent product, and then the possible entrance of the industry, bargaining power of supplier, bargaining power with your customer, right? So those are things. And then 2-month strategy, you definitely have to know that, cost leadership, and then product differentiation strategy. So make sure what's the meaning of those strategies. 4 perspective of balance scorecard, you definitely will have a question from there. So we said we wanted to get our financial, right? How do we get our financial? We have to have a good customer and then market share. How do we do that? We do our good job of the internal business. How can we do that? We have to have a good employee and then the information system, learning and growth. So those are the 4 perspectives. Make sure, you know, if I tell you employee training, you need to know that's learning and growth. So those things, one more time, I don't want to repeat the detail, but make sure you go back to balance the scorecard. Chapter 10, the Excel project 2. One more time, you kind of know what's the meaning of a definition, what's the meaning of dependent variable, independent variable, you know, what's the meaning of coefficient, correlation, coefficient, goodness of fit, those things. If you already did the handout, the quiz actually, you should be able to get those multiple choice. Then we said, once you did the project, you should know how do we get better model. We look at the p-value, smaller is better. R square, larger is better, right? And coefficient, we said the larger means stronger impact. Also make sure you know how do you interpret the model and then use the model to make prediction. We did all this in the project, so I don't want to waste your time and read it one more time here. After that, we did chapter 21. You definitely have that one. I posted the solution to the problem practice. Chapter 23, make sure you know the residual income and WACC. Okay, I think I kind of rushed you to do the review. So let me know if you have any question. Just email me. I'm always here with you until the last day of this semester. Thank you. Let me say thank you from my heart. Thank you for this good semester. I appreciate your understanding. You work with me. You made this tough semester much easier. I want to stop this video before I get too emotional and start crying, you know. I'm always there for you. Thank you.